Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso, and today we're going to be tackling some questions that we get quite often, and they always surround the mortgage. Should I have a 15-year mortgage? Should I have a 30-year mortgage? Or other questions are posed is, should I make extra payments toward my mortgage, or should I pay my house off? Anthony, have you gotten those questions before?
Quite a bit. In fact, even today, I was talking with a client, and he was making extra payments towards his mortgage.
What I've found is there is a lot of misconceptions or half-truths that kind of surround this conversation, and so today we're going to be addressing those.
What's the biggest half-truth that you see?
The biggest half-truth that I see is that when someone is making a comparison between different mortgages, is that the variables are not the same.
What do you mean?
So when someone's comparing a 15-year mortgage and they look at the amount of interest that's being paid, they compare that directly with the 30-year mortgage and the amount of interest that is being paid, which we know with a longer mortgage that is going to be more interest that comes along with that, but the time frames are different, and so that's not a valid comparison. And so you can't do that. So you've got to take into consideration all the variables, and that's really what we're going to touch on today. Is not only are we going to look at the amount of interest that is paid in each of these scenarios, but really there's maybe 4 or 5 other variables that you need to take into consideration when you are contemplating or comparing these options.
Right. And so first thing most people are looking at are the numbers. Right. But we say all the time on the podcast that there's more to life than numbers. So like there's the seen and the unseen. So what we can see is the interest in the numbers. And so this is a very common question. Should I get a 15 or a 30-year mortgage? And so we actually created a video that goes through and actually crunches the numbers. And so that will be in a link in the show notes. We're going to try to stay more high level since this is an audio podcast. But, just as you said, Karen, most people think, well, what do most people think is better, a 15 or a 30?
Most people think a 15 is better.
Okay, and why?
Because that's what they're told. Because they pay less interest.
Right, exactly. So what we did in the video, and we're actually going to give you the answer to the video now.
The secret's out.
Yeah, but what we did is, if a 15 is considered better than a 30, then wouldn't paying cash be better than a 15?
Logically, you'd think so.
So what we did is we did the math, which we say all the time. We compared, what if you pay for it in cash? What if you do a 15? And what if you do a 30? And just like Cameron had said that there's different time frames, which we need to account for, but there's something else that you forgot that we need to account for. And I just like pointing out things you forgot.
Sure.
And that's going to be the extra payment.
Okay.
Cash flows are different.
They are.
Right. So if you do pay in cash, then you have no mortgage.
Correct.
Right.
Yep.
And if you pay in the 15, you're gonna have a higher mortgage. If you do a 30, since we're spreading out longer, you're gonna have a lower payment. So what we have to account for, we just can't focus on one piece of the interest. We have to focus on, well, when you have a 30, your payment's less. Or if you're paying in cash, you don't have a payment at all. So in order to properly compare these, we need to look not just at the interest, but we need to look at what are we doing with that extra payment. And so one unknown here is, what is that earnings rate on your savings account? So what we try to do in the video is try to make things as simple as possible. So what we did is we said, what if your savings rate equals what the mortgage rate is? At least that way there was a comparison.
Okay.
So, and when we ran a 30, paying cash. So no mortgage. So you have 100% equity, but then you have no payment. So we said that what if we put that payment aside each month and earned a earnings rate? Okay. Then we did a 15, and with the 15, after 15 years, the mortgage is paid off, and then we start saving for the other 15. Then what we did is we did a 30. So that extra payment was going into our savings account. And the thing that was very interesting, when we looked at the numbers, they were all the same.
So wait a second. What do you mean by they were all the same, Anthony?
What I mean, for example, and again, I'm assuming the interest rates on your savings are the same. And also the interest between a 15 and a 30-year mortgage are the same. And I know the mortgage is actually slightly less. It's not that much less than a 30, but we at least need to start right at the same point. But with the 15-year mortgage, right, after 15 years, mortgage is paid for, right? Mm-hmm. You got 100% equity and no mortgage. On a 30-year mortgage, you're still going to have a balance at 15. But you want to know what? The balance in your side fund equals the balance in your mortgage.
Okay.
So thus, in theory, based on these numbers, if you wanted to do a 15, but we're a little hesitant on the cash flow, you could do a 30 and just put that extra money in a side fund. And in essence, in 15 years, you'd have enough money to pay that off if you wanted. So you could make a 13 just the same as you would on a 15. Now, on the paying cash, we did the same thing. If you put money aside in that savings account, right, you're all three of these scenarios are going to have this in end of 30 years. All the mortgage, there's no debt. And their savings account all is the same amount. So just like you'd mentioned before, when we're typically evaluating a mortgage, we're just focused solely on the interest. But when you take into account the cash flow and what you do with it, the numbers are all the same. Now, I still think there's a lot of value to watching that video because for one, you can see us do math, which who doesn't enjoy watching that? But we also go into more detail about taxes and some other things. So actually, when we did the video, we thought we were just answering 15 versus 30, but really we were answering about opportunity cost, savings, and some other things. So that's actually my second favorite video.
Great analogy there. A great summary of kind of the video that we have on there. So I'm going to just kind of summarize, if I can, for the listeners, is what we just talked about first was when we're comparing a 15-year versus a 30-year, really the common mistake that most people make is they stop with the comparison just looking at the interest, right? What you were addressing was the different payment periods, right? 15-year versus 30, and the savings opportunities that come along with those different payment periods. And then the opportunities that we have for the savings is, hey, if we take a 15-year mortgage, right, we can start saving the difference between the 15-year versus 30-year in month 181, whereas in the 30-year mortgage, we can start saving immediately, right? Awesome. So what else should we look at when we're comparing these two? We've got interest that we just compared, which is where most people stop. We just talked about savings opportunities. What is maybe another point that we could look at?
Well, let's talk about one of my favorite subjects.
Okay.
Right. Well, so far what we've talked about is what we can see. Like we're looking at the numbers, but there's some other things as well that is unseen. And one of them I would say is taxes.
Okay. So in taxes, where does this come into play in taxes? Is the I won't pose it as a question to you, but when we're paying that interest, right, on that mortgage, is that deductible, Anthony?
It can be. Okay. And I will say with the latest tax changes, they raise the standard deduction, so some people aren't able to deduct. The standard deduction's higher than the mortgage interest, right? But assuming you can itemize, then the interest you pay on your mortgage is tax deductible. And so here's a question, Cameron: which 15 versus 30, which one has more interest?
The 30-year mortgage.
Right? Mm-hmm. Which we had talked about or were told is a bad thing.
Yeah.
Which I wouldn't say is always a bad thing. Right here, it's a good thing.
Yeah.
because now we are creating more tax deductions.
Totally agree. Yep.
The numbers are all the same in the long run, but the 30-year is going to pay less in taxes.
Mm-hmm. Awesome. Great point. So we've kind of talked about taxes. The third point that I would kind of take into consideration as well would probably be inflation, right? And I know no one better that talks about inflation and mortgages than Aaron Chapman. No, not you.
Okay.
But Aaron Chapman. And so I'm going to defer to Aaron on this piece of the conversation. We just put out a recent video where Aaron talks about the effect that inflation has on a mortgage payment over a 30-year time frame. And he kind of coined this phrase. He called it an inflation-adjusted payment. And in his example, he was talking about buying a rental property, but it's the same scenario here. The example that he gave us was that you finance $68,000 over a 30-year period. The actual inflation-adjusted cost of that is actually $64,000. And so the takeaway for that is that, man, inflation is actually working in our favor when we're taking out and stretching out those mortgage payments over a 30-year time frame. And that's really difficult to illustrate, and it's a tough concept to grasp for a lot of people. That's probably one of the reasons that we've had Aaron come back 2 or 3 times now on our show, is because the way that he explains it is probably the best that I've heard. And so I'm going to defer to him. So we'll make sure we got the show notes. We got his link to the show notes in there.
So kind of what I'm hearing you say, or really Aaron say, is that the value of the dollar loses its buying power with inflation.
Absolutely.
And thus, when you get a 30-year fixed mortgage, your payment is fixed. So maybe that's, say, $1,000 a month, but $1,000 a month today isn't going to be the same as $1,000 10, 20 years from now.
No.
Right? So what we're doing is we are paying down, we're getting the value of those dollars today, but we're paying them back with less powerful dollars.
Yep. Agreed.
Perfect.
Yeah. Well said. Thanks for summarizing. One more intangible that we should look at when we're having this conversation is the idea of risk. And Anthony, when we're considering risk in this scenario, let me ask it to you this way: is who has more risk? Someone that has their house completely paid off and 100% equity, or someone that has a mortgage on their house?
Well, I would say it does depend how you define risk. Because I will say the person who has a 30-year mortgage has an obligation each month.
Yeah, I would agree.
Okay, so there is that. We do need to address that. There's that required payment. But what we're kind of evaluating, somebody who is saving, right? So they're going to have some money on the side. So ideally, we want to have, the question gets to be is, where do you want your capital? Mm-hmm. Inside or in equity, or would you rather have it outside somewhere else? Right. And the downside of having it inside the mortgage or the house paid off is that if you want to tap into it, you have to ask permission.
Yeah, you got to get approval.
And I know I've said this on the podcast before, but our friend Patrick Donho, I love the way that he says banks are like your neighbor who will loan you an umbrella when it's sunny out. But the moment it starts raining, knock, knock, knock. Hey, Cameron, that umbrella I loaned you, I need it back. And you're like, well, it's raining. You're like, I know. That's why I need it back. Right? Banks want to loan you money when you don't need it. So if you have that equity tied in your house and you need money, you're going to have to qualify for it. And if you do, okay, you can get their permission. But what we want to be in a position where sometimes you need money faster, or maybe the bank's not going to approve you. Maybe business is difficult, or we've had some issues in the family and maybe your credit score is down, right? So we don't want to have to rely on asking permissions from a bank.
Absolutely.
So I guess in the big, my answer would be you have more risk if that equity's tied in the house.
Absolutely. I completely agree. right? Is I think the same thing is the safety and security of not having all of your money inside equity in your house, lets me sleep better at night.
Yeah, and one thing I want to say is, well, this is what I like to say about paying off the house. Like it's never a bad idea to pay off or down your mortgage, but rarely is it the best idea. Because we're just what we've analyzed so far is just assuming your savings is going to equal the mortgage rate. And the mortgage rate right now, we're literally at all-time low.
Mm-hmm.
And I think I shared on this as well. My son got a mortgage and he got 2.75.
Crazy.
For 30 years fixed. I literally told him, if you prepay this mortgage, I'm going to slap you. Right? If you can't earn 2.75, well, again, that's tax deductible. So maybe the true cost is 2. You can't earn more than that somewhere outside.
Mm-hmm.
But I will say, there are some times when you do want to pay off your mortgage, right? And that could be maybe you're in retirement or soon to be retirement, or maybe also the house is getting close to being paid off. Because here's one thing that I personally use when I'm looking at a loan. Like, let's say, for example, a car note. I'm just using some round numbers, but say it's $60,000, right? Or the car payment, say $1,000 a month. I don't want to give up 60 to save $1,000 a month.
Yeah.
Okay. But now let's say it's 20,000 or maybe 10,000. Like at that point, then there's a lot of bang for your buck, because I can put in $10,000 and I can free up $1,000. Because as we've talked about in the last podcast, a lot of our listeners' goals is to create financial freedom, right? Which we're taking it from Robert Kiyosaki, is your passive income, or PI, or your pie, is bigger than your monthly expenses, or ME or me. So my goal is to make my pie bigger than me. So when I have $1,000 car payment, ideally I want to lower that me. So sometimes there does make some sense to go ahead and pay down a loan. I'm using a car, but it could be the same thing for a house. Mm-hmm. I got a friend who
you have a friend?
Well, I got a lot of friends on Facebook.
Okay.
Right? Okay. But he's doing really well, and his mortgage, I think, is under $100,000, and I think his mortgage payment's like 3 or 4. So I'm like, you know what? And he's sitting on some cash. I'm like, you know what? I mean, I wouldn't have maybe paid down the mortgage so far, but since you're already there, looking at your financial equation, I think it could make some sense on paying that off. As soon as you pay it off, you get a home equity line of credit. Get those HELOCs now when the bank will approve you. So when you do need it, you have that accessible.
Great point. And then the last thing I'll add there was I'm not opposed to it either. Is I've helped clients, right, that have come in certain situations. We do want to get that house paid off. And in that scenario, what I've done is actually put together a pay down schedule for them. And this is one thing that not a lot of people are familiar with, but there's a difference between refinancing and recasting your loan. Is when when someone refinances your loan, you're initiating an entirely new loan on your house or entirely new mortgage. When you recast, you keep the original loan, but they just recast your monthly payment. And so that is really, really, it's a very handy tool when someone is trying to accelerate that pay down schedule. And I'm going to make these numbers up here, but so you get the idea is, like in your situation, you said that somebody had kind of paid down their mortgage. He had $100,000 left, and his mortgage payment was $3,000. Let's say he started at $500,000 was his mortgage. Monthly payment is $3,000. Let's say he's paying it down in chunks of $50,000. Typically, if you just send your mortgage company $50,000, they're going to expect the exact same mortgage payment the next month.
Yeah.
Right. And so all you need to do is you can write a letter of instruction asking them to recast your loan. And what they'll do is they'll take that $50,000, they'll apply it towards the principal. They recast the mortgage or the loan, and what they do is they will lower your monthly payment going forward. And that's really handy because now what you do is you take that difference and you can send that back over into savings. And then we just build up our savings over the next 12 to 18th month period. And then we do that over again. But recasting, if you have a need or a want or in a situation to do that, it's a really valuable tool that you can use.
So Cameron, when would you recommend somebody to pay down or off their mortgage?
Usually I've only done this a handful of times, and it's usually when somebody is, 60, 65, and their intent is, hey, I want to retire in the next 5 to 7 years. And so we want to get that thing paid off. And their intent is to have the home mortgage paid off and then just have no concern about monthly cash flow on that end. And so we'll put together that strategy for them. And, if somebody wants it, we'll help them get there, right? It's all dependent upon their goals, not mine.
Exactly. That's why it's important for their goals. And sometimes people have the goals like they want, it's important to them to pay off the mortgage. So then again, just as we said earlier, we don't just want to focus solely on the numbers, right? If something's important to you, then let's try to help you get there, right? But now let's talk, we've talking about 15 or 30, right? But what do you say to somebody who's out there and they're just plugging maybe an extra 100 or 200 or 1,000 towards their mortgage?
Yeah.
What would you say there?
I would go back to their goals. Mm-hmm. What are we trying to get accomplished? And really that extra 100, 200 bucks, whatever it is them saving, right? They're choosing to put that couple $100, that savings amount into whatever vehicle that is. And now they're choosing the mortgage. And so I would ask them what kind of benefits they're receiving from that, and if that's getting us any closer to our goals. And if it's not, then we need to reconsider what we're doing.
Yeah, when somebody suggests that, I always ask them a couple questions. One is, are you getting any tax advantages by making that extra payment? And you'd say,
no.
No, if anything, we're that's less interest. So if anything, we're going to be paying a little bit more in tax. So there's no tax benefit. Are they going to lower your monthly payment or recast it?
No.
Right? Maybe if you do a lump sum, but if you're doing an extra small amount, they're not going to recast it.
They don't, and recasting actually costs about $200. So,
okay.
Yeah.
Right. But okay, then also, what happens if you need that money? Like how difficult or how easy is it going to be for you to access it?
Not very.
Right. So when we start looking at those things, rarely would I recommend somebody paying a little bit extra. And what we got to look at is what are they really trying to accomplish?
Yeah. Right.
And really what they're trying to do is save. And they're like, well, here's a great way to save, right? It's, well, I wouldn't say it's great, but I think people think it's great. But what I'd recommend is we need to have liquidity. And if you have a lot of liquidity, that's one thing, but most people don't, right? A lot of times, I just had this conversation today. This would happen in '08. Like most people's wealth or net worth is in their home and their 401k.
Yep.
And when, and I'm not saying if, when there's a financial crash, what happens to both of those?
They fall.
Right? They fall, right? So that means your net worth, your assets went down, which I don't think that's that big of a deal, because I know we talk about net worth is overrated, but the problem gets to be is there's going to be opportunities when that happens. And if your money is all locked up into an asset that's going to be hindered during the financial crash, you're not going to be able to use that to your advantage. But if you have some liquidity outside of the equity, that's the ability that you can take advantage of these deals. Because when this recession hits, there's going to be a lot of assets for sale. And so you need to start preparing and having some liquidity for when that opportunity comes, you can take advantage of it. Because if you're like me, you remember '08, and got frustrated, and you saw, my neighbor's house being sold for 50 cents on the dollar. Man, I wish I could have bought that, or I wish I could have did all these things. But what I told myself is, you know what? This won't happen next time.
Yeah.
The next time I'm going to be in a position when everybody's assets are falling, that's an opportunity for me, for my assets to rise.
Well said. Awesome. So let's summarize this conversation, Anthony, right? Is really what we talked about today is when someone comes to us and says, hey, should I be making extra mortgage payments? Right? Should I have my house paid off? And really what they're asking is, should I have a 30-year or a 15-year mortgage when you're coming down and to actually do the numbers on it? And so what we highlighted today was really, gosh, what did we hit on? 5 different things, 6 different things that really you should be looking at when you're analyzing or trying to make that comparison. 1 is going to be the interest. 2, we can look at taxes. 3, we looked at inflation. 4, we looked at savings opportunities. And 5 was risk. And then we did talk about some intangibles in there as well. So I hope that was helpful for today's conversation, and you guys have a good day.
Make it a fantastic day.
Take care.